Investing doesn't have to be expensive, confusing, or complicated. You want the basics conveyed in a way that is easy to understand. I'm your host, Lena, partner at Sensible Portfolios, and this is my podcast, inspired by real investors who want to pay less, earn more, and retire better. Welcome to Retirement for Real. Everyone wants to get high returns for their investments. Today, I'll share with you the secret to higher investment returns. I like to think of taxes, fees, and human error as holes in your investment plan, leaking money that you need for retirement. The secret to keeping more of your money is to plug these leaks. Invest in low-cost, passively managed investments that don't try to outsmart the market. When you do, you can get a great return and achieve your goals without sacrificing your sanity. Let's focus on the simple fact that lower fees mean higher expected returns. Vanguard says it perfectly. If the money is going somewhere else, it's not going to you. And I think they're spot on. The costs you pay for your investments can profoundly impact your returns, especially over the long term. And there are many different costs in investing. You may not even be aware of some of them. The secret is to reduce these costs. To demonstrate, I'd like to put it in familiar terms. We know about the positive effect of compounding returns. The same is true for compounding costs. Fees and expenses, while deducted from your account, compound and add up to be significant sums over time. Since the money is deducted from your account directly to pay the annual fee, you also lose the future earnings you would have made if the money had been invested. Let's say your advisor's fee is 1.5% of your assets under management, and it's deducted from your account each year. Not only are you going to pay that annual fee, but the real issue is how much that 1.5% will cost you over the long term, say 20 or 30 years into the future. It's a simple calculation of compounding. Over 20 years, the damage of this seemingly small fee can add up to 25 or 30% of your portfolio's future growth. The true cost you pay isn't just 1.5% of your assets each year, but 25 or 30% of how much your portfolio earns. Because remember, it's not just the fee you pay, it's the money you would have earned if it had been invested. When you put fees and expenses in terms of total costs over the long term, it's easy to see how high fees can have a corrosive impact on your returns. High fees can be the difference between retiring when you want or having to work longer. Again, lower fees mean higher expected returns. Now, here is something else you don't know about fees and expenses when investing. You've heard of the term, you get what you pay for. Consumers judge lower-priced items to be of lower quality. There is truth in this statement in some cases. Unfortunately for investors, it doesn't apply to mutual funds. When it comes to investing, you get what you don't pay for. Research on mutual funds has shown that high-cost funds often generate a lower return than low-cost funds. A study by Morningstar found that low-cost funds tend to lead to higher total returns. Index funds and passively managed mutual funds often have lower fees compared to actively managed funds. You'll have a better chance of earning a higher expected return with a cheaper fund. A case can also be made when considering financial advisor services. An expensive advisor doesn't necessarily mean a quality advisor. Because of the lack of understanding and transparency around the corrosive impact of fees on your investments, it's easy for financial advisors to overcharge. For some retirees, using a low-cost financial advisor may meet their needs and improve your long-term returns. Once you understand the negative impact of high fees, then you can start to avoid them. The thing is, a lot of these fees are hidden or not clearly communicated to you. To be a smart investor, you need to be aware of them. So here is a list of some of the most common hidden fees. Expense ratios, also known as mutual fund fees. An expense ratio is often charged when you invest in mutual funds. It's a percentage of assets under management, and it's charged yearly by mutual funds. For example, if the fund has an expense ratio of 0.5%, for every dollar you invest, 0.5% is deducted as fees. So if you invest $1,000, only $995 is actually invested, and the $5 deduction is the fee you pay. Most mutual funds list their expense ratios on the fund perspective or website. I encourage you to check it out. It's important that you compare similar funds and their expense ratios when you invest, because surprisingly, they can vary rather significantly. A fund's total expense ratio also includes management fees, which are the costs related to operating and maintaining the fund, hiring a professional investment team, marketing expenses, legal administrative costs, all to ensure adherence to laws and guidelines. Passively managed funds like index funds typically have low expense ratios because they simply track the returns of a benchmark, and they have low costs. Actively managed funds generally have high fees because these fund managers incur great costs to try to evaluate and select the stocks they believe will beat the returns of the benchmark. A 2020 study by the Investment Company Institute found that on average, the expense ratio for actively managed stock mutual funds was 0.74%, while index funds had an average expense ratio of just 0.07%. This difference in fees makes it difficult, extremely difficult, for actively managed funds to beat the returns of a comparable index fund, especially over the long term and after taxes. Trading or transaction costs. When fund managers buy and sell securities for the fund, they incur trading costs. These are commissions paid to a broker to carry out the trade. Typically, these costs are passed on to the investors, so the more activity a fund trades, the higher the costs in the fund. And these are costs in addition to the management fee charged by the mutual fund. Front end and back end loads. So some mutual funds offer different classes of shares. Each class invests in the same portfolio stocks but with different fees and expenses. Class A shares of a mutual fund typically charge what's called a front-end sales load. This is a fee investors pay when they purchase fund shares. Class B shares, on the other hand, they charge a back-end sales load, which is a fee investors pay when they sell or redeem their shares. The amount varies and typically decreases the longer the shares are held. Class C shares may charge either a front-end or a back-end sales load. Some mutual funds charge 12b-1 fees to cover the distribution and the shareholder service expenses. These are typically intended to cover marketing and related sales expenses. As you can see, there is a long list of fees, and more fees in investing. When you aggregate all of these costs, it's easy to see how they can impact your returns over time. So remember, the secret to higher investment returns is reducing your costs. That's it for today's episode. Thank you for listening to Retirement for Real. Tune in to future episodes every other week. Thank you for listening to an episode of Retirement for Real podcast. If you're looking to learn more about low-cost investing, check out our website, sensibleportfolios.com, and click on Book a Call to speak with me directly. This podcast is for entertainment purposes only. It should not be relied upon as a basis for investment decisions. This podcast is not engaged in rendering legal, financial, or other professional services.